We are recording.
Okay, well, hi, I'm Tracy with Fidelity, and I want to thank Walt for always putting together some great content for us on a regular basis so that we can all get our CEs and get more educated about what's going on in the market. Our title is Fact or Fiction, and I just wanted to mention, to remind you all to use your Fidelity Agent app. So in there, there's some great social media posts that you can post, and there's one in there now that's called Fact or Fiction. Are we in a housing bubble? And I think everybody's curious about that and what's happening, and hopefully Walt has a crystal ball to help us navigate this. But there is some great social media stuff that you guys can utilize. That's $10 for a year. So if you don't have your app, reach out to your favorite sales executive and we'll get you all signed up. And I also wanted to mention, I hope you guys have all heard about Breeze. It's a really easy way to send disclosures over when you take listings. It's really easy for you and it's really easy for your client. So if you haven't heard about it and if you haven't signed up, if you would like a link, just email me and I will get you guys all set up. And with that, let Walt take it from here.
Perfect.
Thanks for coming, everyone.
Thanks, Tracy. And yeah, thanks all for coming. It's, who knew a month ago when we started talking about the course, and then Tracy, you and I started going through the title of the course, who knew that we would be where we are today with the media and everything. And, we had a very interesting day yesterday, which was one of the most pivotal days that we've had in the mortgage industry since 1994. So we had a rate increase of 0.75% or 75 basis points to the Fed funds rate. And that showed really that the Fed is going to be strong on inflation and try to kill inflation. And that's their number one job and goal, is to kill inflation. Yesterday the market started recovering from the losses that we had, and we'll talk more about that in a minute. And then today we've heard that the market is down right now, but yet we've had no major economic news in the U.S. This shows that we're in a global economy. We had the Swiss bank that, instead of raising their Fed funds rate, which we had Korea that was talking about raising their Fed funds rate yesterday. We had the ECB talking about raising their Fed funds rate. So it's trying to kill inflation across the world. The Swiss bank said, nah, we're going to wait. So now our market is down today. So thanks, Swiss bank. That was awesome. Anyway, so thank you for everybody that's coming. Again, I want to talk about the media. I want to talk about inflation, talk about rates, talk about all the things that we're hearing in the media right now, as we get so much misinformation in the media. And then at the end, we're going to wrap it all up with the seller buy down strategy, with 3 different seller buy down strategies that will help you and help your clients, and also will help you be able to transition into working with financial planners and other individuals as well, if you wish to. So Tracy, again, thank you so much for hosting the class and for organizing it and getting everybody on.
Thank you. And I'll be doing your CE credits while we're in the class, and they'll go out to you guys tomorrow. So if you don't have them in your inbox by tomorrow afternoon, reach out to me and we'll get you set up.
Perfect. I need to get my picture here, my obligatory picture of the Facebook showing I'm doing my class.
Oh, okay.
All right. Well, let's run through. First I need to share my screen, don't I? That would be, I'm just so excited about the class, I forgot to share my screen. Okay, so you should see my slides right now, right? Thumbs up.
Yes, we got it.
Okay, guys. So fact versus fiction, fact versus opinion, really fact versus fiction. So in today's market, do you have a relevant market opinion, and what's that based upon? Where are you getting your information? Really in today's market, it's more important than ever to be able to get good, sound education and information. So therefore, where I get my information from, I vet multiple different ways. I'm going to be a little slower in bringing some information out, but I want to vet it and make sure that it's correct. So if you remember back, and the reason for this is because if you remember back when Mark Zuckerberg was being interviewed by Senator Hatch, he talked about, how do you make your money? What's really the purpose of Facebook, and how are you making your money? How do you monetize Facebook? And Mark just said, Senator, we sell advertising. Well, that's exactly what the media is doing, is they sell advertising. And our clients right now are having questions as to, should I wait? Should I, our price is going to go down? Are rising interest rates going to cause prices to fall? Now isn't a good time to buy a home. The market is going to crash. Even last night, I had the privilege of talking to a graduating class at Shemeketa and talking about fiscal literacy with them. And as I had an opportunity to chat with them afterwards in the breakout session, I had a person come up to me and say, we've got $115,000 in the bank, and my husband's convinced that the market's going to crash, and so we're just waiting to buy. So they've got money sitting there in the bank, which is losing value due to inflation, and then housing is rising. And as I explained to them, that's a really a terrible decision. So you want to buy a house as soon as possible. As we talk about rates here, I want to talk about some of the misinformation and some of the, it's really tough to manage the market and know where the market is heading, even for, I'm going to call them our elected officials, but they're not elected by the general public, but the Federal Reserve is elected by the president. And there's 8 Federal Reserve chairmen. There's Chairman Powell, who is the main head. He's the one that spoke yesterday. And then you have under him, you've got Lael Brainerd, who is the vice chair. And then you have the other chairs throughout the nation. You have, and I forget where they all are. I want to say they're in, of course, New York, Chicago, and LA, but then there's other chairmen throughout the US, and they all talk. Well, this was Lael Brainerd. And in 2020, he said, Lael said, support letting inflation run hot to exceed 2% target rate. So it was okay. And remember, in 2020, we were printing money left and right. Now, during that period of time, I just recently heard that we have printed 40% of the actual money that we have in the US, we printed in the last 2 years. That's causing inflation. Now, they're saying that they support letting inflation run hot to exceed 2%. Then, almost a year later, in April 2021, inflation expectations remained well anchored at 2%. So they're good on inflation, and it's going to be well anchored at 2%, not going to go above 2%. Then 2021, I expect inflation to decelerate. Okay. Now remember, in 2021, this is when they're talking about inflation being transitory and it's really not that prevalent in the market. And well, then in 2022, inflation is too high and getting inflation down is going to be our most important task. Well, what happened to it decelerating in 2021? And what happened to it being anchored at 2% in 2021, April 2021? Then in June of 2022, they get strong on inflation. This is the Fed. Won't stop hikes until inflation comes down. Right now, it's very hard to see the case for a pause. We still got a lot of work to do to get inflation down to our 2% target. Not ready to say we've seen peak inflation. Now, I do agree with that last statement. Not ready to say that we've hit peak inflation. We haven't yet. It still is running high. Here we've got Janet Yellen. Now, Janet Yellen is now the US Secretary of the Treasury. But remember, if you go past, she was the head of the Federal Reserve, the one that it's her job to kill inflation, to keep inflation in check, because when inflation rises, inflation is a killer on mortgage-backed securities and bonds, and therefore inflation rises, and as inflation rises, rates rise. So In November of 2021, she said she expects inflation to come down from its 3-decade highs in the second half of next year as the pandemic pressures on the economy ease. Then in 2021, December, just a month later, she says, it's time to stop calling inflation transitory. The Treasury Secretary said the new virus variant could further fuel price increases, but she cautioned it was too soon to know. But she's saying inflation's not transitory. Now, if you go back to a comment that she made, and I couldn't find this, but I remember a comment that she made in the last 2 years, and I think it was last year, and she had said, I'm paraphrasing, don't worry about our national debt, it'll take care of itself. So I'm concerned about where her mindset is. Now, just recently, in June of 2022, Janet Yellen admits she was wrong on inflation. Okay, she was the head of the Federal Reserve. Her job is to know inflation. She was wrong on inflation. I was wrong about the path inflation would take. So I'm concerned as she should know these things. I mean, that's her job. Now, June 10th of 2022, she's now stating U.S. economy will slow, but avoid a recession while gas prices are unlikely to come down. Let me restate that because that is very, very important. Janet Yellen says the U.S. economy will slow, but avoid a recession. Yesterday, when the Fed raised the Fed funds rate by 0.75%, they guaranteed they're pushing us into a recession. So Janet Yellen is a little off base. Here again, we go Janet Yellen on inflation and why the U.S. will likely avoid a recession on June 10th, 2022. CNBC now, they're stating that a recession will hit in the first half of 2023. The stock market is now resembling a slow motion car crash. Stock investors start to bet the Fed will tip the economy into a recession. These are all within the last week. The economy may be slowing, but recession fears are overblown, these experts argue. So are we going into inflation or a recession? And you have Morgan Stanley, the CEO, saying, yeah, we got like 50-50 odds that we're going into a recession. Morgan Stanley, whoops. So that was the Morgan Stanley CEO. And then later, Morgan Stanley warns of a recession. Markets should brace. So let me tell you the truth about a recession. We have low unemployment rates right now. And this is a chart that goes all the way back. So the dark areas are all recessions. And as we go all the way back to 1950, the white line shows our unemployment rates. Now we have low unemployment right now I think it's 3.5% if I remember the last employment report, 3.5, 3.6, it's in there. Anything under 5% unemployment is considered full employment for the US. So we're at full employment for the US. Every time, literally every time here, as we look, as rates or as unemployment has ticked up and has done it in a major way, every time we've hit a recession. Every single time we've hit a recession. So a recession's coming. We know that a recession is coming. Now, don't be nervous and don't be scared about a recession, because in our world, in the mortgage world and the real estate world, remember that when a recession hits, mortgage rates fall. So a recession could be a good thing for us, and a recession will lower our interest rates. And that's what the Fed is trying to do right now. They're trying to get a hold on inflation, raising the Fed funds rate by that 0.75%, trying to get a hold on inflation to then bring us really technically into a recession, which then they'll lower the Fed funds rate and then our rates will start to fall. Now, this was the chief economist for Freddie Mac. And honestly, I'm going to listen to him a heck of a lot more than I'm going to listen to any of these guys over here. simply because he's not selling a product. And, he is not selling advertising, as Mark Zuckerberg said. So I believe that he's going to be a little more truthful about what's going on. So Sam said, home buyers continue to show resilience, even though rising mortgage rates are causing monthly payments to increase by about 1/3 as compared to a year ago. Several factors are contributing to this dynamic, including the large wave of first-time home buyers looking to realize the dream of home ownership. In the months ahead, we expect monetary policy and inflation to discourage many customers, weakening purchase demand and decelerating home price growth. Now, he's saying decelerating home price growth. We had in the month of April, we had 2.6% appreciation across the US. We can't substantiate that. We can't continue that. CoreLogic brought out year over year inflation at over 21% in the month of April. So we still have huge inflation, or I'm sorry, huge appreciation. So 21% appreciation and 2.6% appreciation just in the month of April. We're not going to continue seeing that. We're going to see some decelerating of that. We're going to see some moderating of that, some slowing of that, if you will. I'll get into home appreciation growth, but we're anticipated to see really about 9% this year. So it's going to be lower than the double digits that we've seen. And thank goodness, because the double digits that we've seen, we just can't continue. But it's our job to help our clients understand that. And so take pictures of these slides, share them with your clients. I'll send out the slide deck as well, but take pictures of them and share them with others. So one point that I want to bring out here, including the large wave of first-time home buyers looking to realize the dream of home ownership. Remember that, because that is key to what we're coming up against. So I'll come back to that statement. Mortgage rates and recessions. Again, every time that we've had a recession since 1980, and we can go back all the way to 1942. I was looking for my chart. I couldn't find it real quick, but going all the way back to 1980, every time we've hit a recession, rates have gone down. And that's still the case. Rates are going to go down as we hit that recession. So a recession means opportunity for us. We know rates have gone up. They're going to continue going up a little bit. It looks like they'll probably go up through the summer as we hit the fall. When we hit the fall, then they're anticipated to start going down. The deputy chief here of Freddie Mac said mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increases is likely to moderate. Now, I wish that was the statement yesterday or the last couple of days, because we had a massive increase of rate in the last couple of days. However, much of the increase in rates in early 2022 is an anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy. What happened to the interest rate increases that we had seen in the last really week? I want to show you the bond chart here in the last week. Friday, we had the CoreLogic report that came out. I'm sorry. No, we had the CPI report that came out that showed that inflation was 8.6%. It had increased. And the market didn't like that. So we had a major sell-off. During that period of time, the CoreLogic report came out showing that appreciation has increased and that we were at 21% year over year, as well as we had 2.6% just in the month of April. Now here, as we look back at November, this is when the Fed finally admitted, even though they'd missed before, they finally admitted that inflation was prevalent in the market, that it was not transitory, that we really needed to pay attention to inflation because it's serious and it's going to hurt us. Well, as that happened, we had Christmas sales and then we hit January. Then you know the story from there. We've had a major deterioration of the market. After yesterday's 75 basis point increase of the Fed funds rate, we ended up being up on the day 114 basis points, recovering some of those losses that we'd lost last couple of days. However, today we're now down, last I saw, we were down 25 basis points due to, again, inflation worries across the global economy. And I will come back and answer some questions here in a little bit. So as we talk about home values, now I talked about rates, and this is a way to be able to combat rates with your clients, guys. Understanding that mortgage rates will go down. Now's a great time to buy a house because you most likely will be able to refinance as rates go down. We know that rates will go down at some point. It's just a matter of when. So now you can get in, get that appreciation, get the house that you want. The reality is that with rates higher, it's taken some people off the market. Some people, either it's affordability and they can't afford the house, or some people have just gotten nervous and they're not going to buy. They're going to wait for a little bit, but this is a good time to be able to get the house that you really want. So watch for the unemployment report. And as soon as you hear, I mean, literally, it's almost like clockwork. As soon as you hear that the unemployment rate has ticked up, a recession is almost here. It is within months at that point of being here. So watch for that in the market. So let me go through and answer some questions here real quick. Yes, great time to buy. Sean, thank you, very helpful. We share, yep, I'll share my slides.
I'll watch the questions, Walt.
Okay, cool. Yeah, just let me know if you have if I have a question I need to answer. So,
okay.
And guys, some questions I'm going to avoid because I'm giving you so much information here at the start. I'm going to circle it all back around at the very end. So, and Susan normally answers a lot of our questions. She's on our presentation today. Susan's our awesome loan officer, Spanish speaking, Susan Dunphy. And so I've asked her not to answer a ton of questions today, as she normally has been, because I want to circle back around and bring everything at the end. So I want to give you guys a lot of stats and a lot of information, a lot of articles to be able to combat what we're hearing in the media with your clients. So as we go to home values, again, we have these 40 overvalued house markets could see 15 to 20% home price declines if a recession hits. Okay, so that's bad, right? We have Diana Orlick. Now I'm going to pick on Diana here a little bit because whatever she's saying, just do the opposite. She is a commentator for CNBC. In 2017, this picture came up. Nearly 50% of homes considered overvalued in 2017. Prices 10% over sustainable level. However, she finally admitted, and just recently, this was within the last month or so, the evolution of a $3,000 home, a $300,000 home. You see price appreciation here, 5%, 15%, 21%. So you would have lost that money. As we go on to what she says. Now, again, this is a perfect example, guys, and I would take a picture of this and share this with your clients because this is a perfect example. This is Diana Orlick, and this is CNBC. Now, CNBC, I have been on CNBC. I'm on CNBC once every couple of months. I'm either on CNBC, Bloomberg TV, or the Travel Channel as host of Financing the American Dream. So I've been on CNBC. Diana Orlick, housing bubble fears. So listen to this. In October 2015, housing today, a bubble larger than 2006. Holy cow, that would scare the crap out of me if I was getting ready to buy a house. If you did not buy a house in 2015, you would have lost 5.1%. Or on a $300,000 house, you would have lost $15,000. 2016, August, we're in a new housing bubble. Okay, but I thought the housing bubble was in 2006 or 2015. Okay, 5.4%, you would have lost $17,000 on a $315,000 house, increasing to $332,000. So 2017, home ownership doesn't build wealth, studies find. What? Home ownership doesn't build wealth, but yet there's so many studies that say it definitely does. But okay, Diana, You don't buy a house. You just lost 6.1% or $20,000. 2018, it's better to rent than buy in today's housing market. Are you freaking kidding me, Diana? Because I'm remembering these years were pretty decent years for housing, right? 4.1% appreciation. You would have lost $14,000. 2019, the housing market is about to shift in a bad way for buyers. Again, you would have lost 4% or $15,000. December 2019. Next year will be hard on the housing market, especially in these big cities. Well, crap. So I don't buy because I'm listening to Diana Orlick and I'm listening to CNBC. I would have lost 16% or $61,000. July 2021, housing boom is over as new home sales fall to pandemic lows. I would have lost 18% or $80,000. Now remember, she goes back and says, 2017, home ownership doesn't build wealth, studies find. Well, if you had listened to her, you wouldn't have bought a house in 2015. You wouldn't have paid $300,000 for the house, and the house would not be worth $523,000 a day. You would have lost, what is that, $223,000? Come on, Diana, you're a little off. So homeownership does create wealth, and it does create wealth for our clients. As we look at the chief economist for NAR, National Association of Realtors, of course, home prices in the meantime appear in no danger of a meaningful decline. He continued, there is an ongoing housing shortage and properly listed homes are still selling swiftly, generally seeing a contract signed within a month. With mortgage rates rising, Union forecasts existing home sales to wane by 9% in 2022 and home price appreciation to moderate to 5% by the year end. There is an ongoing housing shortage. That is true. We have more first-time home buyers now than we ever have. The average first-time home buyer is 33 years old. This is something you need to be sharing with your clients. The average first-time home buyer is 33 years old. We were told that millennials were going to lead this market right now. They are. The average first-time home buyer is 33 years old. We have more 33-year-olds hitting the market than ever before in the history of the U.S. They're the ones that are buying the houses. And the other key, and properly listed homes. Very interesting when you look at the stats. 47% of homes across the U.S. had a price correction or a decrease in price. So the realtor listed it, and then they lowered the price for some reason. 47% of homes. So is that because the seller, you want to grab the listing? And I was told by a couple of realtors yesterday when I asked this question, they said it's exactly the case. They got the listing, and they're trying to appease the seller, and they don't want to lose that listing because listings are gold, of course. So they're saying, okay, seller, we'll list at your price, but yet after 2 weeks or a month, we're going to go to my price because this is the realistic price. So you're educating them on it, but you're saying, hey, I'll list the house and we'll try your price. And I get that. So 47% of homes had that lowering of, had a price reduction. However, the average home sold for 106% of list price. So even with that lowering of the sales price, 106% or of the homes we had, it was like 70-80% of the homes had 106% ask over list price. So you still had some properly listed homes that weren't properly listed that then reduced in price, but yet it was like 70-80% of the homes sold were sold at 106% of list price. So there's still bidding going on. There's still some things going on that are bringing that price over asking price. And I think that's important to know. Housing stays strong through recessions. Again, this is the demand. This is Case-Shiller showing the demand of housing, and you can see that it consistently increases through recessions, with the exception of 2008, which we know that 2008 was an anomaly year. So consistently we have
strong house, housing stays strong. The other thing is that when you're looking at interest rates, a lot of people believe, again, that as interest rates rise, then home prices decelerate, decrease. Well, these are the recessions, and these are the recessions that we had more than a 1% increase in interest rates. And you can see that the home prices all increased during those periods of time. So as interest rates fall, home values continually go up as well. So that's a good one to share. That's from Freddie Mac. April data suggests a positive turn of events is on the horizon for weary buyers. If the trends we're seeing now hold true, we could potentially see year-over-year inventory growth within the next few weeks. Chief economist for Realtor.com. Here again, our friend Diana Orlick. Mortgage rates spike as inventory rises. Okay, sending the media, the press, hey, our inventories are rising. Inventories are rising. Mortgage rates are spiking due to that. Well, no, Diana, mortgage rates are spiking because of inflation. So that's why it's spiking. And when you're calling a spike, well, just as we had the monthly monthly listing counts, just in April, we're talking about 6,000 homes. That's not really a spike. Now we do see that the blue represents new listing monthly counts for 2022. The green is 2021. But you can see that we're starting to turn that table where we're getting more listings hitting the market than we're selling, which will help, but it just started. And you're talking by 6,000 homes across the US, which is really nothing across the US. As we look at new listing counts in thousands for May, we had 541, and I don't have the 2021 numbers there. So, we have new listing counts are increasing, but of course, we always know that through January, February, March, April, new listings always increase anyway due to seasonality. So the chief economist, Realtor.com, again, there's a long uphill climb to balance, but it starts with heading in the right direction, and April data shows a lot of promise. So, they're saying, hey, housing looks good, looks strong. I want to share this with you because, again, this is something I show my clients all the time, and it's a real important visual here. So starts completed. We have on a year-over-year basis right now, we have roughly 1.3 million new homes started. So these are new construction. Single family completions, about 1 million homes. Multifamily completions were about 300,000 homes. However, there's about 100,000 homes that are destroyed every year due to fire and due to just, remodeling and whatever. So total unit supply is around 1.2 million on any given year right now. However, household formations, these are the millennials hitting the market. Household formations, 1.4 million. Remember me stating and making a big point that there are more first-time homebuyers hitting the market than ever before. This is them, and they're hitting the market for the next 5 years. So household formations, 1.4 million household formations. But with that, then we have a 200,000 house formation deficit where we're not making enough houses to take care of all the new households that are hitting the market. So we're in a deficit of 200,000 per year right now. Freddie Mac says that our current shortage without building any new homes or anything is 3.8 million. So we're running in a deficit every year at 200,000 plus. So next year we should be current shortage around 4 million homes. The year after, I read a report that builders anticipate they're going to be able to start to get caught up to what we need around 5 to 7 years from now. But it's going to take them 7 or 10 plus years to really start to get caught up. So Are house prices going to fall? No, they will not. It's supply and demand. And we know the laws of supply and demand. We saw the laws of supply and demand. If you need to teach it to your clients, talk to them about lumber. Say supply and demand, lumber. You heard what lumber did. Lumber prices got way up during, they ended up going way up during COVID, and then they're back down now. Supply and demand, it drives prices up. Toilet paper. Look back at when COVID hit. I mean, crap, there was price gouging on flipping toilet paper. And so we couldn't get toilet paper, and some stores started charging extra on toilet paper. I mean, the governor had to say stuff about it, and all of that. So supply and demand, the laws of supply and demand are true. They are real. They are prevalent. And we are still 3.8 million homes short of where we need to be. So just from this chart alone, it helps a lot of clients get over that realm of, oh, housing prices are going to fall. Also, as we look back at 2008, and we've kind of beat this to death, but in 2008, the thing that really led to a lot of the market housing issues was real loose lending guidelines. So here is just a quick chart showing all the loans that we've done below a 620 credit score. You can see that we did a lot of loans with a 620 credit score back in 2007 that were below a 620 credit score. And you can see that we haven't done a whole lot since. It really, when you hit a 620 credit score anymore, your interest rate is pretty significant. And it's really tough to get financing anymore. Now, foreclosures. Foreclosures, we're hearing about those. So this was 2022, February. U.S. foreclosures surge in January after end of pandemic freeze. U.S. foreclosures are the highest since the pandemic start. Well, we had 151,000 foreclosures in 2021. We had 214,000 foreclosures in 2014. Now, we had less foreclosures, about half of what we had in 2019 because of the pandemic. There was a freeze on foreclosures. So, but you can see that foreclosures have been going down consistently since that period of time. So let's look at the truth behind it. This is Rick Sharga, Executive Vice President of Market Intelligence at Adam. They're the ones that really monitor foreclosures. He says 78,271 U.S. properties with a foreclosure filing during the first quarter of 2021, up 39% from the previous quarter. Then you go on. But even with the large year-over-year increase in foreclosure starts and bank repossessions, foreclosures activity is still only running at about 57% of where it was in 2020, the last quarter before the government enacted consumer protection programs. So we're running 57%. So are they really on the rise? Well, yeah, they're on the rise a little bit to pre-pandemic levels, but we're still running at 57% of where we were before. So where's this housing bubble? I'm talking to the choir here. So where's the housing bubble? There is no housing bubble. I've proven through slides, through charts, through misinformation of the media, there is no housing bubble. When we look at the home price forecasts for 2020, these have been revised. They were much higher, and we're at the beginning of the year, they were anticipating that we would see a home price appreciation this year of in the 12 to 13%. It was double digits. Now it's been revised down to 9% on an average. So you've got, Fannie Mae still believes and Freddie Mac still believes that we're going to see some double digits, but yet, you remember NAR, we talked about NAR. He's even revised it now to where it's down to 5% instead of 8.4. But really anything above, even if we're at 4% or 5% appreciation, let's just say that you buy a house, and this is something that our clients need to understand. You buy a house, and I'm just going to use $100,000 for round numbers because it's easier for me with math. But you have $100,000 house that you're buying, and you put 10% down on that house. You put $10,000 down on that house, and so even if it increases by 4% or 5%. And let's say that it's not 9%, but it's 5%. Well, you just made $5,000. You invested $10,000 and you just made $5,000. On an investment stand, I mean, who would not want to do that? I own the property. I invest $10,000. My first year, I have $5,000 worth of home appreciation. I just made $5,000. That makes sense all the time. Who would not want that investment? Housing is a great investment and always is a great investment. So what questions do you guys have before I start to run through here? Really seller buy down strategies. And we'll do that in the last little bit here. Do we have any other questions?
Looks like there's a question on the mortgage rates. Is it tied to the federal funds or the bonds? It's under the Q&A section.
Yep. So mortgage rates are not tied to federal funds. So what the Fed did yesterday, they did not directly affect mortgage rates in the fact that when they raised the federal funds rate, they are raising the rate at which banks either can borrow money from the Fed or can borrow money from those banks that can borrow money from the Fed. There's only like 5 banks in the US that can borrow money from the Fed. The rest of the banks then borrow money from those that can borrow money from the Fed. So they raise the Fed funds rate. When the Fed raises the Fed funds rate, the Fed then banks then raise prime lending. And prime lending is what we're all based upon. So yesterday they increased, as the Fed increased the Fed funds rate, they increased short-term lending, which would be home equity lines of credit, auto loans, and credit cards. They did that to slow our economy down, to slow inflation down. That's the key. So they raised the Fed funds rate to then slow our economy down and slow inflation down. From there, then the bond market, we're tied to what the bond market is doing. The bond market watches and listens to what the Fed is doing. So as the Fed raised the Fed funds rate yesterday, if you got the email that I sent out earlier in the day, I said that it was a very pivotal morning, and the market was looking for a 75 basis point increase in the Fed funds rate, because if the Fed did anything less than that, then it would scare the market. And if they scared them, if they did anything less than that, they would be sending a message to the market saying, we're really not strong on inflation. We really don't care about inflation a great deal, because it needed that 75 basis point to really start to halt the economy. The Fed yesterday, as they did the 75, if they did a full point, 100 basis point increase, then they would be sending a message to the market that the Fed is scared, which then would freak the market out. So they did the 75 basis point, which is exactly what the market needed. Hence, the market responded with 114 basis point increase throughout the day. And at that time, as the bond market increased, our rates started to get better later in the day yesterday. As we look at that chart of the bond market, our rates are tied directly to the bond market and what the bond traders are doing. That's a great question. So here, this is not a Christmas chart. It is green is good and red is bad. Red means that we've closed down on the day, meaning rates have gotten worse. And you can see just over the last couple of days, rates have gotten significantly worse. We're now in the 6s. And so that's exactly what's been going on. Is there's so many factors that can change the bond market, whether it can be rumors, it can be statistical data, inflation, whatever. But our rates are tied directly to the bond market and what bond traders are doing. So I hope that makes sense.
A lot. Sean has a question about the housing bubble in higher end homes with low first-time buyer participation, where buyers are more affected by the stock market. I don't quite know what the question is. Is the housing bubble in higher end homes with low first-time buyer participation, where buyers are more affected by the stock market? Well, yeah.
Well, so I think that higher end homes are going to be a little harder to sell, just simply because there's not as many people that can qualify for those. As interest rates have increased, it's taken more and more people out of that higher end home market, because as rates are 6%, I mean, that just increased their payment by $1,500 to $2,000 sometimes. So it's going to take more people out of that higher end home market. So I don't see a housing bubble in any of the markets, period. We just don't see the appreciation on the higher homes happening as much as the lower homes. Lower homes are going to have more appreciation. Just again, think of it as in the aspect of supply and demand. I mean, how many people can, how fast can a Ford go up in value compared to a Mercedes? So if you've got $150,000 Mercedes, it's not going to go up in value as much as a Ford that is $30,000. That Ford that's $30,000 today is going to sell next year for $35,000, the next year $40,000, the next year $50,000, where that $150,000 Mercedes is going to stay at $150,000 for the next couple of years, and then it might start to increase a little bit, but it's just laws of supply and demand. Just think of it that way. I think that's the easiest way to look at it. So I hope that answers your question. If not, Sean, then just give me a call and we can chat further on that. But great question.
And then I don't know if you want to, Susan also answered this, but maybe chat about it. Just why is Freddie and Fannie even important if they're not responsible for the 2008 crash?
So, and are you looking at what their economists? So I guess my question is you're asking, why are they important? Well, is it important? So yeah. So are you asking why Freddie and Fannie are important when I'm quoting them? Maybe that's what the question is because I'm quoting their economists. They're the ones that know what's going on with the economy. And I'm going to believe them more than I'm going to believe the media, because the media is there to sell advertising. But Fannie and Freddie are not there to sell, anything. So if their economists are going to say, oh, why are they even still around? Well, because the government bought them. So, and that's the main purchaser of our mortgage, or they're the main purchasers of our mortgages. So they're the ones that secure all of our conventional mortgages. And the subprime market in 2008 blew up. And the subprime market is starting to come back. It's called non-QM. But if we didn't have Fannie or Freddie, we wouldn't have mortgages around. So
there is a good question that I think people need help understanding is how does raising interest rates help inflation?
Rising interest rates are due to inflation. It doesn't help inflation. It is due to inflation. So is a cause and effect. As we have higher inflation, at that point, then we have higher interest rates. Because what historically happens is, and it's been interesting to watch as of late. So as you have higher inflation, our goods and services cost more, which means companies historically make more money. So therefore, there's more of a move to the stock market when we have higher inflation. We saw that earlier this year. We haven't seen that as of late because of all the uncertainty that's happened in the market. But typically, there's a sell on bonds because bonds are really they're long-term interest rates, but mortgage-backed securities are going to be safe returns. So if you think of it this way, I think the best way to look at it is in a quick realm. Some of you might remember this in COVID, but you probably would remember it going back to 9/11. So when 9/11 happened, the stock market lost well over 50% of its value. And it did it for a period of time. We were down at 7,000 points for a while. It happened because of uncertainty. So the stock market lost its value. Money came out of the stock market and went to the bond market. Now I'm talking on just a really high altitude investment level. So instead of getting in all the weeds. So people invest in the stock market for higher yields, higher returns when there's certainty in the market. Inflation creates some certainty in the market in the fact that goods and services are going to be worth more and companies should be making more money. So therefore, money goes out of the bond market, goes into the stock market for higher yields, higher returns. As we can see, there's been a major sell-off in the bond market. as we have uncertainty hit the market, like 9/11, like COVID, at that time, there's a sell-off in the stock market and money goes to the bond market for higher yields and higher return. I'm sorry, for safer yields and safer returns. Does that make sense?
Mhm.
So cool. Okay. Any other questions on that?
I think we are good.
All right. So, so we've got 10 minutes to cover seller buy down strategies, which really should be a class in its own. I really wanted to cover all of the other things. And honestly, guys, on the seller buy down strategies, I'm just going to fly through it really quick in 5 minutes. But just give me a call and I can walk you through it. Give Susan a call. She'll walk you through it. So, but if you want to know more, but right now, there's in the last 14 days, and this, I may be mistaken on that. I may have changed this to the last 30 days. But I'm going to say within the last 30 days, there were 219 homes that had price reductions just in our area right here. So 219 homes had price reductions. As I clicked on a few of these, I don't have access to the MLS, so I've got to go to Redfin to check these things out. And when I looked at it, I was seeing price reductions of 20,000, 30,000, you know, all over the board. I mean, 5,000, 10,000. So it's all over the board. Now, a good idea is that when you do a price reduction, what happens is if your current list price was 450, if your new list price is 400 or 440, you just took $10,000 off the sales price, you really just reduced the monthly payment to the house of $58 a month, which is nothing. I mean, just honestly, guys, that's nothing. And so to a buyer, that is absolutely nothing. It may help, but yet that's what we've always done. And we do the status quo over and over, right? So instead of lowering the price of the house by $10,000, take that $10,000 and keep the price of the house $450, but take that $10,000 and then remarket it and offer to pay closing costs or offer other ideas. And I'll come across those here in a minute. But what's happening is that when you lower the price of the house by that $10,000, it's almost like buying a house at $405,000. So, you know, with that $10,000 seller buy down strategy. So, you know, here's just an off the wall idea. And those of you that know me know I love off the wall ideas, right, guys? I love looking outside the box, thinking outside the box. Imagine a house, imagine marketing a house and saying, buy this house and have $198,000 in retirement in 30 years. Who wouldn't want to buy that house? I mean, that's crazy talk. But yet, if a client comes into a property and if they have all their own closing costs, they can pay all of that normally, but there's a $10,000 price reduction. Well, it only saved the client $58 a month. So that's not going to really make it luring to them. So yeah, you reduce the price by 10,000 bucks. Okay, it's 58 bucks a month. But yet I could take that 10,000, and this is where a financial planner would love you. I can take that 10,000, invest it with a financial planner, and at 10% over 30 years, that $10,000 grows to $198,000. So, I mean, that's massive, guys. That is, I mean, absolutely massive. And so I can own the house, I can buy the house at $450, and I can have an extra $200,000 at the end of 30 years. Think of the ways in which you can market that. The other thing that we're starting to see is really affordability. And so, and I checked this out with a few financial advisors that I worked with yesterday. I checked it out with them yesterday. And so I asked them if they're having clients now starting to come to them, starting to withdraw a larger chunk of funds to meet where they would have been pre-approved just in 2000, you know, in January on a monthly basis. And so, and they had, you know, the ones that I checked in with had said, yes, they're starting to get more and more people coming in saying, hey, I need to withdraw a larger chunk of my funds to buy a house to meet my payment where I wanted to be. So here's a seller buy down strategy just on, you know, $550,000, purchase price of $550,000. That person in January, where it was approved at $550, that same payment at $19.19 per month, they would be pre-approved today for $438. So it's going to be considerably less. But yet buying a house at $550 and $438 is significant in between the two, right? So then they say, okay, great. If I buy the house, if I want to keep the same payment and I want to make it affordable, then I can take out, I can bring up my cash to close to $222,000 opposed to $110,000. So that means I've got to withdraw funds. So it can be worked out two ways. One, what my suggestion is instead of withdrawing all the $222,000 worth of funds, instead of 110 cash to close, and this is just down payment. This is not closing costs and everything else. So you can end up, instead of withdrawing 222,000, you could do a seller buy down strategy, buy down the interest rate. So instead of 5.75, buy it down to 4.75 with $13,000 roughly. You can then take $72,000 out of your investment account instead of all, it saves you about $40,000 and you're bringing $182,000 to close instead of $222,000 to close. So you're able to keep more of your money in that investment. I'm going to bring more out with the seller buy down strategy. So really watch us over the next several months. I believe that these are going to be strategies that are going to be really important as we go forward. A lot of the questions that we have is, well, how's that help the seller? Well, it helps the seller. It helps the seller help the buyer become more affordable in their houses. And I think that affordability, and I think as we have higher inflation, more and more people are going to be looking at affordability, and they're going to be really worrying about cash flow and that. And so I think that the larger homes are going to be harder to sell. It's just, you have less and less people that are going to be able to buy those homes. And so therefore looking at things like the seller buy down strategy, instead of reducing that price by 10,000, what can you do with that 10,000? How can you market the house? Can you pay closing costs? Can you lower the down payment or lower the interest rate, buy down the interest rate? Can you use that 10,000 to maybe buy out mortgage insurance, if that makes sense? I mean, what can you do with that money? Can you use, 15,000, 20,000? What can you do with that money to be able to help clients get into more homes? So anyway, just watch us in the future. Any last questions? Did all this make sense? Because I went through it all so fast.
I think we'll need to do it again. No, it was awesome information. Thank you, Walt. We had an amazing amount of people on this call, so I hope everyone got a little bit out of it. We'll be sending out the recording and the slides as soon as we get them. Your CE should go out tomorrow. Yeah, thanks for all the information, Walt. That was really, really great.
Perfect. I hope it was helpful, and I hope that it really gave you guys the tools to be able to help your client. You are the expert, and our clients are looking, needing, watching for the expert to appear. You guys are the expert. So share this with them.
Okay, awesome. Cool. We'll see you guys next time.
Thanks, guys. Have a great day.
Bye.